Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi taala wabarakatuh. My name is Muhammad Nazmi bin Azhari, PDA 1805103, and today we gonna present about the taxation for assignment taxation 2. So, first of all, in the taxation we have many branch of type of the taxation, and one of the branch that I will present is about how the company can be resident in Malaysia. I will state the relevant section. Generally, a company is regarded as a resident in Malaysia if at any time during the basis period for a year of assessment in whatever year the company is in Malaysia. At least one meeting of board of director is held in Malaysia concerning about management and control of the company. So if whatever company is around the world make any one meeting of board of director in Malaysia, it will be considered as a resident in Malaysia. So the relevant section that related to the company can be resident in Malaysia is section 8.1 section B that state the essential factor to ascertain resident status of a company. So that is important to the company that have placed in Malaysia to know the status of the company that involved in Malaysia, because when the company is known as a resident in Malaysia, it will be have different tax implication that will be give to them. Next, I will present about what are the tax implications might be received by a company when it is a resident and non-resident in Malaysia for relevant year of assessment. So, the scope of charge. When the company is resident, the income that scope of charge of income that the company will be included is income that accrued or derived in Malaysia and outside Malaysia. So the worldwide scope. If the company is resident, the company will be charge the income in and outside. But that is different for non-resident. That the income accrued or derived only in Malaysia. So is that if the company is non-resident, the income outside the Malaysia is not chargeable. Then about the double taxation relief. So the company that resident in Malaysia is applicable about the double taxation relief. So that is very useful if the company have disabled employer that make double deduction, donation. And for the non-resident, they have no specialty about double taxation relief. If the company have disabled employer, the company didn't have any relief. Then the income tax rate. The income tax rate for 2016-2019 flat rate is 34% for resident, and the flat rate for non-resident is 24% during year 2016 and 2019. So we can get the difference between the company that have a resident status between the non-resident status. So if you all have company in Malaysia, you will get many relief and exemption, then have a flexible income tax rate. So that is very important for a company that in Malaysia to have resident status. So I will further this presentation to my other group members. So I hope you all still in this video because it help you in tax selection. Okay, thank you.
Assalamualaikum. Hi, my name is Muhammad Hafiz Fitri bin Ismail. My number ID is PDA 1805075. So next, what is Inland Revenue Board of Malaysia? In Malay, we call it Lembaga Hasil Dalam Negeri, or English we call it in short form IRB. So what is IRB does in practice to identify the company be a resident in Malaysia? So step number 1, IRB in Malaysia has made it requirement for the company to acquire confirmation of its residence status may apply towards any branch of issuance of COR. What is COR? COR is certificate of residence that be issuance by the IRB in Malaysia. So step number 2, COR can be applied either by manual from the company or through the e-resident in the website of IRB. So the company can search the Google about the e-resident in the website and can apply the COR in the e-resident. And step number 3, tax resident status can be confirmed based in its YA, means the year assessment of the company. And so next we gonna step on the what type of tax return form used by the company for the submission of income tax. So what is the form that we use, the company use to send to the IRB? Form C. Form C, return form of company for the year assessment 2014. So this is the requirement for the Form C return to the IRB. Number 1, the period for the submission via e-filing within 8 months from the date following the close of the accounting period. As an example, the company must send the Form C to the IRB within 8 months between January until August. So next, failure to submit will be a penalty can be imposed under subsection 112 in paragraph 3 of ITA 1967. So the penalty will be charged to the company that failure to submit the Form C to the IRB. Okay, so from my discussion, so we know about two things. The first one, what IRB does to identify the resident status of the company in Malaysia, and second, what form that the company use to return the year assessment to the IRB, which is Form C. So I pass the next discussion to my mate.
Okay, we meet again for the further discussion. So we have know about the resident, about the form, about how to manage the company, and now I will describe about procedure that must be complied by the company that residential in Malaysia. So there is a few way to the company to finish the tax of year of assessment in the year. So the self-assessment system has been implemented for the companies beginning from year of assessment of 2001. So the first step is the company have to furnish estimated of the tax. So the company have to estimate the tax, then make installment payment to complete the tax. The third step is to determine the tax payable by using the calculation in the form to have a tax payable that can make the company have a value of the tax that might be chargeable to them. Then file return of Form C to Inland Revenue Board. Inland Revenue Board that the previous moderator that have been discussed is Inland Revenue Board is important to have and to calculate the tax of the company. So the company has to file a return Form C before the due date. For the 2019, the due date of the Form C is 15 December 2019. So the company must file return the Form C before the due date. So I have concluded that procedure that must be put in the company to settle the tax. Then I will further for the next discussion.
Okay, Assalamualaikum warahmatullahi wabarakatuh. My name is Faiz Hakim bin Darwis and I will explain furthermore about type of penalties that might be imposed if the company does not apply with the SAS. Okay, first penalty is underestimate income of tax payable. A company is given two opportunities to revise its estimation, which compile within 6 until 9 months or both. Next is penalties on monthly installment. So penalties in monthly installment is state about any installment which is not paid by 15%, the amount unpaid will be increased into 10 until 20%. Okay, that's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. First of all, my name is Muhammad Danish bin Mansur and my number ID is PDA 1805062. Okay, now we move to the difference between the SST and GST. The first difference is SST are implemented since 1970s and has gone through a few improvements. But the GST was implemented on April 1st of 2015. So the second difference is the SST will only be imposed at the manufacturer or consumer level. Service tax is imposed to consumer who are using tax services. And the GST, the tax imposed on each level of distribution, which are the manufacturers, wholesalers, retailers and customer, but the paid input tax can be claimed by business. So it differs like SST. It cannot be claimed by a business, but GST can be claimed by a business. So the third one is some importers, manufacturers, wholesalers or retailers fail to declare their taxes through transfer pricing. But the GST able to curb transparency, misappropriation and tax payment issues. And the last one, the most important one, the rates. So the SST rates may vary from 5% to 10% or specific rate plus 6% with service tax. But the ST system is one standard rate, which is 6% and it is not an added tax. So that's all for the difference between GST and SST. Okay, now we move to the chronology of changes from sale and services tax and GST and back to the new form, which is SST in Malaysia. First of all, the 2018 was an eventful year for Malaysia. Pakatan Harapan has emerged as the ultimate winner of the country's 14th general election and effectively replaced the Barisan Nasional as Malaysia's ruling government. Soon after, PH has worked to fulfill its manifesto, which include the replacement to GST to SST. Okay, now I will explain a bit detail basic concept of SST. SST is a one-stage output tax and is governed under two separate laws. Namely, the first one is sales tax, which is mainly for manufacturers and importers. And the second one is service tax, which is mainly for service providers such as accounting or IT or F&B. So the basic concept of GST is the GST is a consumption tax where taxes are imposed throughout the entire value chain of a product under the value added concept. So the chronology is there's going to be a change of tax in Malaysia come 1st September 2018. The new tax which is going to be introduced is known as the sales service tax, and the SST is set to replace the GST in Malaysia. The move of scrapping the 6% GST has paved the way for the reintroduction of SST, which will come into effect in 1 September 2018. Before the 6% GST that was implemented in 2015, Malaysia levied a SST, which is sales tax and a service tax, governed by the Sales Tax Act 2018 and the Service Tax Act 2018. The sales tax was a federal consumption tax imposed on a wide variety of goods, while the service tax was levied on customers who consume certain taxable services. So the conclusion is the transition from GST to SST have advantage and disadvantages. Its impact will indeed be felt over the long term, mainly in terms of cost and living and the strength of our ringgit. Time would tell whether or not the transition is a bright move for us as a nation. So that's all from us. Thank you.